as you see, the standard is called IAS 10.
Okay.
International Accounting Standard number 10, events after reporting what? Period. Now, yes, you need to know why we speak about this. The reporting period, you could say that maybe we have a company, the operations of which start on 1st January in a certain year, and then end on 31st what? December. This is common, right? Although, of course, it's not
Yes.
necessarily to be from January to December. It could be any month, as long as 12 months period is satisfied, which is a common accounting period for a lot of entities, right? Okay. Now,
Okay.
what do we mean by event after reporting period? The year may start on January and end on December, right? But now,
Yes, sir.
the financial statements, this just shows that the financial statements should follow the normal principles from January what to December. But just having completed, just having been done with the year, right, for a particular period, doesn't mean the financial statement will be outright ready to the stakeholders, right?
Yes.
Okay. What has to be done is there are procedures, there is auditing. Auditors may come, they may check the statements, right? Everything may be fine,
Yes.
maybe, and after a certain time, let's say even 2 months from the end of the year, I'm just presuming, not necessarily 2 months, it could be three, it could be one, whatever, right? But actually,
Okay.
when everything has been settled, then the financial statements are now authorized for issue. They are ready to be provided to the stakeholders, and then we say we are done with this. So whatever comes from this point onwards, which was right, which should have been accounted for even before, we don't consider it any longer, and we consider it an error and account for it in the future what? In the next accounting period, right?
Okay.
Yes, so that's what we call events after reporting what? After reporting what? Period.
Period.
Events
Period.
after the year end, after the end of the reporting period, up to the date the financial statement is authorized for what? For issue. So there could be a lot of events taking place between these 2 points, right? That's what we call events of
Yes.
reporting one period. That's why you say there
Period.
are events both favorable, it doesn't matter, being favorable or unfavorable, of course, which occur between the reporting date, between the reporting what? Between the reporting
Date
date and the date in which the financial statements are authorized for what? For issue.
for issue.
Yes. Yes. For example, maybe by the board of directors. The board of directors are actually management should be responsible for the financial what? Statement. Although they may not be the ones preparing them, even if maybe there are accountants preparing them, but they are the ultimate deciders. They are the ones who will be actually answerable to the shareholders. Board of directors, they act like agents of the what? Of the shareholders
Of
who
the
own the company.
shareholders.
Yes. So that's why they are responsible for that. Okay. So when
Okay.
speaking of these events between the reporting date and the date they are authorized for issue, we could have adjusting, but also non-adjusting what? Events, right?
Events.
Yes, we could have both of them. So we now need to know what adjusting events are and what non-adjusting events are. It's just like that. After that one, the standard is done. So it's simple, right? Yes.
Okay.
So like you see the word itself, adjusting events. Adjusting events are, you see, the year starts on January, it ends on December, which should be fine. But there are events which, as I told you, they are adjusting events which go until the date of authorization for what? For issue. From the year end to the date of what? Authorization. You find
Authorization.
out that something is actually outside of the bounds of the accounting period, right? But it is an
Yes.
adjusting event. It gives you evidence of conditions that existed when during this what? This period. You see that?
Period.
We have three things. It gives what? Evidence of what?
Evidence
Conditions
of
that what?
conditions.
Existed. So not these three things. ECE, evidence of conditions that existed. If we say it is an adjusting event, it means it occurred outside of the period, but it tells you that, oh, you must have overlooked something during that period. There was this issue. So if it was there and you are the only one who overlooked, you cannot say that, okay, let me leave this alone and I will consider it an error for the future period. No, the financial statements are not yet authorized for each, so you still have chance, you still have time to make amendments, right?
Okay.
So we speak of the thin ice here between the consideration of something as an error in future periods and incorporating it, noting the error area, and then making what? Corrections, right? So that's why you call it an adjusting what? Event. It provides evidence of
Event.
something that existed. Okay, you can look at the examples. You know, these examples are the standard itself now, right? You
Okay.
see these examples, but they are the scenarios. For example, sale of inventory after the reporting what? Date for less than its carrying
Date.
amount. Okay, you'll see on inventory, right? You know,
Yes.
inventory is a standard that it measures impairment on its own. Like I told you that you can have a 36 impairment of assets. It helps those standards with assets which actually cannot determine impairment by themselves. But with inventory, we usually measure inventory at the law of cost and the net realizable what? For example, you compare cost against what? Net realizable value. Do you
Net.
remember on
Sales.
impairment we call the fair value less cost to sell. We say that you can call it net realizable value.
Yes.
Yes. So you can
Yes.
see now
Yes.
how things are the same. So on inventory, and maybe let me extend something here. There we compared the carrying amount, which here we consider it as cost, against the recoverable, right? And for the recoverable,
Yes.
the higher of several cost to sell, which is like this net realizable value and the value news. But here we are speaking of inventory. Inventory cannot have value news. You do not use
Okay.
inventory. You do not even use inventory to generate fund, right? You hold inventory for
Yes.
sale, yes. And that's what. So you could call this net realizable as the recoverable amount. It's fine, right? It's a recoverable amount
Amount.
with the exception that here we do not include the value news because inventory is not used to generate what? Cash flows. The inventory is sold
Cash
outright.
flow.
Yes. You see that now.
Yes.
So it is exactly
Yes, sir.
the same. Yes. Okay. So we usually take the law of this one. If cost exceeds net realizable value, it's like when we said carrying amount has exceeded the recoverable amount, and then we have to determine the impairment, right?
Exactly.
So this is where what we are talking now about. Sale of inventory after the reporting date for less than its carrying what? Amount. You see now?
Amount.
So something is worth less than what is held in the what? In the books. What does this mean? It gives evidence about net realizable value of inventory at the reporting date. Remember, presume that
Okay.
at the reporting date you didn't know whether the value of inventory had fallen, right?
Yes.
You had bought inventory at 800,000, but you find out that after the year end, I can only gain only 600,000 from that inventory. So how can you sell something for a less amount than the cost? That is not normally the case, not normally the scenario, right? So that
Yes.
only tells you that okay, inventory had fallen down. Now presume that at the year end you didn't know this and you held your inventory at cost instead of at net realizable value, right? Then,
Yes.
if nothing specific happened after the year end, then you would say, "Oh, I just didn't know this condition was still there at the year end, right?" But I just
Yes.
hadn't what noticed. It's different to like presume that maybe after the year end, maybe fire broke out. When fire broke out, the inventory got burned, and so their value fell down, right? If the value fell down due to something, due to fire breakout, would be a non-adjusting event. Why? Because it would give evidence of conditions that did not exist at the what? At the year end. It is only after the year end that
Okay.
fire broke out, and then the value of inventory fell what? Fell down. Right.
Go down.
Yes. In the case
Okay.
there was nothing. It was just information. Oh, this thing can be sold at this much less amount. Why? Wasn't this the case at the year end? Oh, it was. I just hadn't noticed that. Okay, I have to go there and adjust in case I didn't. Right.
Okay.
Yeah, so this is just an example and it's a common one, but also here we are told bankruptcy of a customer after the reporting what? Date. You know about bankruptcy.
Date.
If you have a customer and the customer hasn't paid you, in your books you would have something called the trade receivables. You know about that? For the customer,
Yes,
it
sir.
would be your data. Yes. Trade what? Receivable. That's what we do.
Receivable.
Yes. Now, after the year end, the customer became bankrupt. It means before you didn't know it and you recorded maybe in case the customer owed you 10 million, you would have recorded 10 million as usual, right?
Yes, sir.
But now you get, okay, after the year, after the reporting date, the customer has undergone bankrupt. It confirms an allowance, right, is required against the receivable balance at the reporting what? Reporting date. What am I speaking about? Have you ever heard of something called allowance for trade receivable or provision for doubtful debts?
Yes, sir.
Yes. We usually do that because when you say that the customer owes you 10 million, we usually presume that, oh, some of this amount we may not receive, right?
Yes.
2% or how much percent. So, and the measurement of that percent depends on the actual scenario. So, if you find out that you still have 10 million while actually the customer can't pay you and nothing else maybe happened after the year end, it was just something that was there, right? You say that, oh, it
Yes.
seems like I I wrongly estimated the provision for bad what? For bad debts. Because the
Bad
provision for
days.
bad debts usually comes and reduce the what?
The amount.
The amount, you see. So that's why you say, oh, I had made an error, so I should have increased the provision for bad debts, right? And so I should have, if
Yes.
you increase the provision for that bad debts, it would reduce your receivables, but also it would increase the expense in the income what? Statement. So you do,
Statement.
yes. So we just need to get the concept of what we mean about this, right? Okay, then we have
Okay.
this one, discovery of fraud or errors. Oh, this is obvious now. After the year end, you discover maybe there was fraud or error. Isn't this obvious? Someone did the fraud.
Yes.
For example, maybe which example should we take on fraud? I like to use this example. You know, now there is betting. People do betting. There are a lot of betting companies, right? Presume maybe
Yes.
someone, maybe the accountant was receiving fund. Was having the company maybe was having a trade receivable of 10 million. Then the accountant was being paid by customers, right? And instead of receiving, showing that the company has received the cash and reduced this trade receivable, the accountant left this as it was, and they used those funds to go to the betting company, right? And
Yes.
unfortunately, all the money was taken away.
Went.
Yes. So we could say that actually that is fraud, right? Yes.
Yes.
Yes, fraudulent behavior. And so this is obviously if it is fraud, or maybe in case maybe it was an error, you have to correct it, obviously, right?
Yes.
So at the year end, we showed that customers still owe us 10 million while they had actually paid 8 million already, but the accountant is the one who had hidden that. Then we say, oh, we did it wrong. So if the customer had paid us 8 million, we would have to say, oh, this trade receivables is no longer 10 million. We have to reduce it by what? By 8 million, right?
By 8.
Yes.
Yes.
And trade receivables is a current asset, is an asset, and as I told you, to reduce an asset, you credit. So you will credit trade receivables by 8 million, right? And
Yes.
then on the debit side, now, on the reality, this is what we would have done, right? In reality, in case the accountant hadn't made that issue of taking the money and going to bet, right? We would have said credit
Yes.
trade receivables and debit the cash or bank. That's what we would have done. But now remember, see now, that guy has actually done it, and maybe he no longer has that money, right? So you'd have to take this as an
Yes.
expense instead of saying cash. We have lost it, right? 80 million instead of
Yes.
saying cash. We no longer have it, and maybe he's not even able to pay us. Maybe he's also bankrupt. Then we could say, okay, you have to go to statement of profit or loss and record an expense of what? Of 80 million,
Of
right?
8 million.
Yes. So this is just an example. You just need to get the scenarios, the realities of what you would actually face in the business situation.
Okay.
Yes. But
Yes.
also, we have something here: settlement of a court case after the reporting period. Okay, now we'll see this, and there is one standard you will see this about these matters about the provisions, contingent liabilities, and the contingent what? Assets. But for now, you don't need to go deep into this. We just speak of the scenario. Look here. Settlement of a
Okay.
court what? Court case. If the company has a court case, it means that the company is likely to pay something, right? It depends, of course.
Yes.
The possibility or probability or a certainty of paying something. It depends on the likelihood of the situation turning out, right?
Yes.
Yes. Maybe you could have you could be told, okay, you definitely have to pay. At which point you call this a liability. You would see that under I-37. Maybe you could be told, okay, it is very highly probable that you are going to pay. We call this a provision. It's just words. Something that is just probable but not sure, we call it a what? A provision.
A provision.
And maybe there is a little chance, a very little chance, we call this a contingent liability. You know the meaning of contingent, right? Contingent is
No.
something may happen or may not happen depending on the scenario or which you also do not have control of. So we put a contingent what? Liability.
Okay.
You just see
Liability.
that, yes. But actually, you don't need to go so much into these technicalities, but we just need to get to be aware of this, right? So now let's go to,
Okay.
for example, settlement of a court case after the reporting period.
Period.
It means that by the end of the period, we are not sure on whether we definitely are going to pay, at which point we call it a liability, or it is probable that it is more likely than not that we're going to pay a provision, or it is less likely that we're going to pay. It's just a contingent liability, right? But
Okay.
after settlement, you are 100% sure of what to do, right? Maybe you definitely had to
Yes.
pay something, or you didn't have to pay anything. So, since
Okay.
at the year end, we already had this issue, but we are not just sure of the amounts, right?
Yes.
We'll do this. We say it is an adjusting event because we have just had more and complete information about something that was already existing at the year what? At the year end.
The year end.
Yes. So that's why it confirms the existence and the value of the entity's obligation at the reporting what? Reporting date.
Period.
So simply speaking, that's why I told you to stick to these three things. Evidence of conditions that existed, right?
Yes.
Okay, and then the other point you say evidence of a permanent diminution in property value prior to the year end. Maybe the value of the property has fallen down, right?
Yes.
Yes, but you see that okay, maybe it was there before the year end, but actually you just hadn't noticed. Anything that happens after the year end with a big change, obviously, if there is a different reason, they would have told you, okay, something happened, and that's why this was the situation. But if silent, we presume that that thing was still there at the year end, but we just hadn't what? Hadn't noticed, right?
Yes.
And then in the other example here, we say determination after the year end of the sale or purchase price of assets sold or purchased before the year what? And this is just like inventory, it's just the same, right? Determination
Yeah.
of the year end, yes, of the sale price of the sale or purchase price. It's like when we spoke of sale of inventory. Yeah. You detect the actual price or the actual value of something after the year has ended, right? And nothing else has changed. There is no significant event that has happened after the year end to say that okay, this was the reason. So you say that okay, so this was still present just before the year end. So it is an
Okay.
adjusting event. Then you have an unadjusting what? Event.
Events.
And I just know it's just the opposite. So it's those that are indicative of conditions that arose after the reporting what? Reporting period. So you obviously that okay. Or maybe simply speaking, it's the opposite of an adjusting. Because an adjusting, we said it gives you evidence of conditions that existed at the year end. But an adjusting, it could be a condition that existed that did not exist at the year end or that existed after the year what? After the year end.
The year end.
So if you see everything, okay, this happened, but actually it is obviously because of something that was after the year end. So you are not going to adjust our financial statements, right?
Mm. Okay.
Examples now: a major business combination after the reporting date or disposal of a major subsidiary. Isn't this obvious, my friend? You say that, okay, if
Yes.
you as a company, you acquired another company after the year had ended. It's obvious you have got something new after the year end. The other point, announcing a plan after the reporting date to discontinue an operation. The year has ended and you just decide, okay, we are going to discontinue this operation. Or you would see this under IFRS 5, there is this plan. They actually explain the discontinuation of operations. But simply speaking, you can see these wordings. It's something that it just comes out of the blue. It does not give evidence of conditions that existed at the year what? At the year end. And then we have
Okay.
major purchases.
But sorry, sir, just this line. Sorry
Okay.
to cut you. Just here, don't you think? I'm just thinking when you actually explain it. Don't you
Mhm.
think here, something had given a sign, like maybe a decline, maybe a loss in the period, in the before the reporting period, in the course of the reporting period?
I get you. You are speaking of this announcement, right? This announcement of a
Yes,
plan, right?
to discontinue. Yes.
Okay, now you have to get one thing now. You will come later maybe and see more on provisions, contingent assets, and liabilities, right? You would see that about these
Okay.
plans, it even involves the creation of provisions, right? Provision, I told you,
Okay.
it is just a liability of an uncertain timing or amount, which could just be created. And to even recognize that liability, there are conditions that you have to satisfy. Among the conditions you need to satisfy is this one. Management should have made it very clear that it is going to discontinue a what? An operation.
An
Right.
operation.
If not
Oh,
made clear,
okay.
even that provision won't be what? Recognized. And that's why you see this word announcing a plan to discontinue what? An operation. Let me do this. Let me put the brackets here. A good question. You asked a good question. I'm writing IS what here? IS 37. You would see this, right? There is something
Okay.
called the restructuring provision. It is a provision of restructure. You need to restructure the company, right? You need to stop some
Okay.
operations. You need to start some new ones. So, in order to recognize
Oh,
that, there should always be a formal, detailed plan from management, right, on the aim of doing this,
okay.
and that's why you can see this. So, on plain meaning, you could actually feel that. But when you consider this restructuring provision, you could get some point. Oh, this is usually the what? The case, right?
Okay.
So good question.
Okay.
Very good question. Good. And I think after this one, I 10 and the 37 are usually studied together. So after this, the plan would have to change. We'd have to go twice what? 37. No way. Right.
Oh,
Yes.
okay.
Just studied together. And then we'll go back to the finish up those PPE. Okay.
Okay.
Then the other
Yes,
point
sir.
here, we are told destruction of assets by a fire after the reporting date. You see this now. You presume it was that inventory on an adjusting event. You had inventory,
Yes.
it has been destroyed by fire. Okay, we definitely know that the value has fallen, but what was the reason? Does it give evidence of conditions that existed? Obviously, it is an evidence of conditions that did not exist because destruction occurred. That fire broke out after the year what? After the year end.
The
So
year
by the
end.
year end, everything was fine, right?
Okay.
Yes, and then another point here, announcing or commencing a major restructuring after the reporting what? Reporting date, right? I
Date.
think this one you will see, we combine this restructuring with this announcing a plan on discontinuing operation. They are kind of very, very related. I think you can see it. I spoke of restructuring here, and here you can also see it, right?
Yes.
Yes. Okay, another point you are told large changes after the reporting date in foreign exchange what? Exchange rate. You also
Rates.
see the standard on foreign exchange rates. When the foreign exchange rates, that when the rate of exchange actually fluctuate, and maybe by the year end you already use them and you got your converted amounts, them changing actually would also need you to, if you do comply to their changes, your financial statement could actually be adversely affected or favorably affected, right? In a material
Yes.
manner. But if there are these changes After the reporting date, you don't care. You don't say, okay, I prepared my statements, but maybe uh, 1 month has passed, and then I want to authorize my financial statement for issue, but there have been changes in rate. Let me go and change that. Yeah, no. This is just a change that it doesn't give evidence of condition that existed by the what? By the year end. So you let it be. And another point
Okay.
here we are told equity dividends declared or proposed after the reporting what? This is a very, very common example. Of course, the company
Okay.
decided to pay equity dividends after the year end. You cannot say that there are evidence of condition that existed by the what? By the year end.
Then
Yes. For non-adjusting, it is usually obvious. For adjusting, it is when you need to be careful. Here we are told changes in tax rates or tax laws after reporting period. They actually tell you, okay, after the reporting period, there have been changes in tax rates. These ones are based on nationwide, right? The nation just decides, okay,
yes.
let's change the tax rates. Maybe we have changed the tax system. Maybe it was progressive, right now it's regressive or whatever. Litigation commenced after the reporting what? Date.
Period.
You see, before we said that you already had a court case and you already had some notes in the financial statement, right? But maybe
Yes.
after the year end, that court case was settled. So we just got an additional evidence of what was already existing by the year end. But this one, it is a court case maybe commenced after the year had ended. So it is obviously not related to that what? To that year, right?
Okay.
Yes. So that was the situation. Maybe you just need to go a bit further. Non-adjusting events now. For adjusting events, they should obviously be incorporated into the financial statements, right? No discussion. But for non-adjusting, what are you going
Okay.
to do now? We have seen that okay, something happened, but these events are non-adjusting. What should we do? It's not like we
Yes.
ignore them altogether. No, they are important, but they do not have a great chance if they are adjusting what events. That's why you said
Events.
they do not affect any items in the statement of financial position or statement of profit or what? Or loss and other comprehensive
Loss.
what? Income, which are the main statement. All the statements come from these ones, right?
Okay.
Yes. For example, when you speak of the statement of changes in equity, it is equity. Equity is already in the statement of financial position. But however,
Yes.
now look here, for material what? If non-adjusting events are material, when something is material, we mean that it can influence the economic decisions of users of financial what? Statements. If something
Statements.
is great such that it could even impact the decisions of users of financial statements, right? Then we say that okay, uh, I still require the following disclosures. First of all, we have to describe that event. You go to the notes to the financial statements now, right? I told you
Okay.
we spoke of the 5 components of financial statements. So you go to the what? To the notes and you describe that event, but also you describe its estimated financial effect or statement that such an estimate cannot be what? Made. So some people should know it is not going to affect the financial position of profit or loss, but the stakeholders should at least know that in case it was affecting to affect that period, what would have happened, right?
Okay.
They are just provided with a green light of what should have occurred. Okay, now I think let's finish up with these dividends and going concern, and then we do the examples, and then we'll be fine. It's good, it's good. Okay. Now, as for dividends, I
Okay.
think we already did an example here under non-adjusting events. If an entity declares dividends after the reporting what period, we already say
Period.
that the entity shall not recognize that such dividend as a what? As a liability. When the entity says, okay, I'm going to pay dividends, but it has not paid, it means it has created a liability. That's obvious, right?
Yes.
Yes. So what do? We could say that we can credit the dividend what? Liability, DL, dividend
Liability.
liability. But actually now what is going to happen? Whenever we speak of dividends, right? Dividends is paid out of equity and retained earnings
Okay.
actually specifically. So you go and remove something from retained what? Earnings.
Earnings.
Yes, you have not this. Whenever you declare the dividend, it has to be reduced from retained what? I'm repeating again and again.
And
Retained earnings, you have to get that. So retained earnings is part of equity, and so it has a credit nature. So whenever you reduce it, you do what? You debit it, right?
debited.
Yes.
Okay.
And so that's why here we're told only necessary disclosures is what? When you say disclosure is required, just
Disclosure is
explain.
required.
Yes. Okay, then fine. Let's go to going concern issues arising after the reporting what? You have to get this right. When you speak of the conceptual framework, it is an underlying assumption that the company will proceed as a going what? Concern. And that's
Concern.
why even those figures, whatever standard we do study, we presume that the company will proceed as a going what? Concern. If you say that the company is not going to be a going concern, even that PPE you have recorded at some amount isn't worth that much because you're going to sell it at a piecemeal value, which sometimes they call it a breakup what? Breakup. You call
Mm,
the item on a breakup basis, right? You treat non-current
okay.
assets as if they are current what? Assets because they're going to be sold
Asset.
at any time, at any point in time, right?
Yes.
So going concern issues arising after the reporting date. Initially, the company was having a going concern status. It was just fine. You expected it to operate for the foreseeable future. That's what we say. What we mean by the company is having is actually going what concern. We said, okay, we expect this company to operate for the foreseeable future, so everything is good, right? But now, what happens
Yes.
that the going concern is affected after the reporting date, after all your figures in the financial statements were written well, right? But now you say, okay, there is a going concern issue here. That will it will have to prompt you to change everything, right? You cannot say that okay, it's after the reporting date. You see, because that is the
Yes.
basis of preparation of the financial statement. So if you say it will carry after the reporting date, all those statements, it is very pervasive. It has a great impact because it affects all items in the statement, almost all, except maybe those that are already
Okay.
cash based, right?
Yes.
Okay, so that's why I say there's an exception. There is an what? An
An
exception to
exception.
the rule that the financial statements reflect conditions at the reporting date. If after the reporting date, management decides to liquidate the entity, you see, of course, if we decide to liquidate the entity, it means that the entity is no longer a going concern. Isn't that obvious? We speak now maybe of
Yes.
voluntary liquidation. The entity has just decided. Then the entity all cease trading, let's say, maybe you need to liquidate all of the entity or cease what? Trading.
Heading.
Beside that, it has no realistic alternative to the. You know what we mean by this? By liquidation, there is voluntary and non-voluntary. If we speak of voluntary, you have just decided maybe we break down this company, we break up this company, and we form another one. But this trading, maybe you do not have an alternative. Your financial situation is poor, it is very bad, and you need to close down the company, right? That's what we're speaking. So on
Okay.
both cases, if that is stating, the financial statements cannot be prepared on a going concern what? Basis. You have
Basis.
to resort to the breakup what? Breakup basis that I told you. At which point you would have to sell to value assets at their piecemeal value, right? That's why you go back
Yes.
and say, in accordance with IS1 presentation of financial statements, management must disclose any material what uncertainties relating to events. Now, presume that maybe it's not that the company is not a going concern. You are just unsure. There are just uncertainty. If there are uncertainty, you are not going to say that, okay, let me value my asset at the breakup basis. No. You only value them at a breakup basis when you are 100% sure that the company is no longer going what? Concern. But if there is
Concern.
material uncertainty, you are uncertain, and that uncertainty is great. It can affect the efficiency of use of the financial statements, right? We say that
Yes.
management must disclose any material what? Uncertainties relating to events or conditions that exist that cast a significant doubt on the what? On the entity's ability to continue trading, right? Now, if
Yes.
the going concern assumption is no longer appropriate, like I told you, right, there should be a
Yes.
fundamental change in the basis of accounting. I already spoke of the breakup what? Basis. That all assets and liabilities, all non-current assets and non-current liabilities become current assets and current liabilities. The assets are valued at their piecemeal values. That's why you speak of the breakup what? breakup basis, right?
basis.
Yes.
Yes.
So if the financial statements are not prepared on a going concern basis, the fact must be what? Disclosed, of course.
Disclosed.
Yes. Because, going concern is an underlying assumption. If the company is quiet, we presume that the company, whatever has been recorded, is the company is going what? Concern. Because if you
Concern.
if you don't tell them, the assets may be maybe a lot worthy. So even when maybe you classify them as this, and maybe there are stakeholders who are not so knowledgeable in accounting, they wouldn't understand anything. But if you tell them, okay, these financial statements you see are actually been prepared at a breakup what? Breakup basis, so they would know the situation the company is in. You know, we try to
Okay.
protect the stakeholders against all the problems, right?
Okay.
Yes, so that was all. Now we need to go through some examples, and I think we'll be done with this standard, right?